brought to you in cooperation with Restaurants Canada. My name is Chris Elliott, and I'm Restaurants Canada's senior economist. Since its founding in 1944, Restaurants Canada has represented the voice of the food service industry by helping our members across the country grow and prosper. In the last 77 years, we've seen a lot, but nothing has compared to what we've been through over the last 12 months. Before the start of the COVID-19 pandemic, the food service sector was a $95 billion industry, employing more than 1.2 million people, providing Canada's #1 source of first jobs, and serving 22 million customers across the country every single day. The industry has since lost hundreds of thousands of jobs and billions in sales due to the impacts of COVID-19. There is a light at the end of the tunnel, however, with the rollout of the vaccines. Today, we will hear from the Banque du Canada Deputy Governor Larry Schembri as he discusses recent economic developments and how the COVID-19 pandemic has affected household spending and created accumulated savings. Back in January, the Banque du Canada forecasted negative growth in the first quarter, but a strong rebound later in the year. So we will learn how their view has changed since then. Households recorded record savings during the pandemic. What happens when they start spending again? And the lockdowns have affected both incomes and savings. Who has felt it most, and what does that mean for future economic growth? Before we begin today's presentation, Restaurants Canada and the Banque du Canada would like to acknowledge that we are meeting on the land of the First Nations, Inuit, and Métis. We pay our respects to the Indigenous peoples across the country and to their ancestors for their immeasurable contributions to this country. It is now with great pleasure I'd like to formally introduce our speaker for today. Larry Schembri became Deputy Governor of the Banque du Canada in 2013. In this role, he oversees the bank's analysis of domestic economic developments and shares responsibility for setting monetary policy in Canada. Mr. Schembri first came to the Banque du Canada in 1997 as a visiting research advisor on sabbatical from his post as Associate Professor of Economics at Carleton University. He joined the bank permanently in 2001 and became Chief of the International Economic Analysis Department 4 years later. In 2010, Mr. Shembre was named advisor to the governor, a position he held until his current appointment. Mr. Shembre holds a Bachelor of Commerce degree from the University of Toronto, a Master's in Economics from the London School of Economics and Political Science, and a PhD in Economics from the Massachusetts Institute of Technology. His published research has focused on exchange rates and monetary policy in open economies, the international monetary system, and financial stability. The Deputy Governor has kindly offered to take questions from our members following his presentation. Restaurants Canada participants who are registered, please submit your questions at any time using the box at the right of the screen. Deputy Governor, thank you so much for being here today. The podium is yours.
Thank you, Chris, for the very kind introduction. Good afternoon, everyone. I'm grateful for the opportunity to speak to Restaurants Canada once again. I appreciate the close working relationship we have with Restaurants Canada, and especially the valuable insights you've provided on the impact of the COVID-19 pandemic on your industry. Your association represents 80,000 businesses across our country, and in normal times would employ more than 1 million people, as you said, Chris. But we are not living in normal times. All our lives have been disrupted by the COVID-19 pandemic. And unfortunately, some families have suffered heavily, experiencing severe illness and death. The economic impacts of the pandemic have been very uneven, and your industry has borne a heavy burden. Tens of thousands of jobs have been lost, thousands of restaurants have closed, and others are struggling to survive. Many restaurants have adapted with outdoor patios or pickup and delivery. Indeed, my family and I are doing our part by ordering online to help keep our favorite restaurants in business and our friends who work there employed. But it's not the same, is it? For my family and many others, restaurants hold a special place in our lives. That's where we celebrate special occasions and make happy memories. So we're all looking forward to the spring and the promise of better days ahead. At the Banque du Canada, we recognize that Canadians count on us, and we are doing our part to support Canadians. When the pandemic first struck, we responded swiftly and aggressively. We cut our policy interest rate by 1.5 percentage points to a record low. We also injected sufficient liquidity into the financial system to ensure that Canadians could continue to borrow at low interest rates. To further support the recovery, we committed to holding the policy rate at 0.25% until excess capacity in our economy is absorbed and the inflation rate returns sustainably to our 2% target. My purpose today is to explain the backdrop and the thinking behind yesterday's monetary policy decision. In doing so, I will highlight the key developments since our last decision in January and how our views of the economy have evolved. Like your business plans, our outlook is highly uncertain. It is conditional on the evolution of the virus, especially the new variants, and the timing of the vaccination rollout. I will take a closer look at one of the risks around our outlook that we identified in our January monetary policy risk report. It's one that matters to you, namely household spending. And it may be stronger than we expected because of the accumulation of personal savings over the past year. Many Canadians have lost their jobs and suffered financial hardship during the pandemic. But others remained employed and have seen their savings rise for two reasons. First, they've been unable to spend on a variety of high-contact services, such as dining out, traveling, or going to concerts. Second, they've become more conscious about their health and their finances. We estimate that these forced and precautionary savings add up to about $180 billion. There's much uncertainty about what Canadians will do with these savings. This is important because these savings are large enough to meaningfully affect the trajectory of our economy. If Canadians spend more than we expect, it would strengthen the recovery in consumption and employment. I will also discuss some downside risks to our outlook, most of which are related to the pandemic and its possible long-lasting effects. Let me begin with a discussion of recent economic developments. In January, we anticipated a slowing of growth in the near term because of the renewed containment measures in Canada and elsewhere. We also saw a more positive outlook over the medium term. Vaccines had been approved several months earlier than expected, allowing the potential for broad-based immunity to be achieved as early as the end of this year. Since January, the recovery in the global economy has been led by robust growth in the United States. This U.S. rebound reflects the limited impacts of containment measures and ongoing fiscal support. And more fiscal support is on the way. Global and domestic financial conditions and market sentiment remain positive as optimism continues to grow. Long-term bond yields have risen as the outlook for the U.S. economy has improved. For similar reasons, oil and other commodity prices have continued to rise. The Canadian dollar has been relatively stable against the U.S. dollar, but has appreciated against most other currencies. Recent Canadian data indicate that the economy has been quite resilient. Economic activity in the fourth quarter of 2020 and the first quarter of this year has been stronger than we anticipated in January. Consumer spending has been less affected by recent containment measures as people and businesses have adapted to them. House construction and resale activity have been robust, supported by low mortgage rates and a desire for more living space. Stronger foreign demand and rising prices have boosted activity and exports in the oil and gas sector, mining, and manufacturing. Business investment intentions are also rising as confidence in the recovery has improved. However, recent data tell a mixed story about the labor market, which remains a long way from a full recovery. Job losses in December and January were sizable. The losses were concentrated in Quebec and Ontario, in sectors most affected by the restrictions and mainly felt by part-time workers. When employment was resilient in some other industries, surpassing levels seen before the pandemic. The near-term inflation outlook has been revised up. We now expect inflation will move temporarily above our 2% target in the coming months to around the top of our 1 to 3% control range. That reflects rising gasoline prices, combined with adjustments for the prices of numerous goods and services that fell sharply when the pandemic struck a year ago. We then expect inflation to moderate, given excess capacity in the economy. Let's now turn to the impact of the pandemic on income, spending, and savings. The virus caused unprecedented losses in jobs and labor income. It also reduced household spending. However, extraordinary fiscal support more than offset these income losses, so on balance, household income increased. When you couple this with an increase with a drop in spending, household savings rose dramatically. This outcome may seem puzzling, but the story behind it largely rests on the pandemic's uneven impact across sectors and workers. Let's first look at the impact on labor income. About 3 million jobs disappeared between February and April of last year, of 2020. High contact sectors, primarily services, as well as low-wage workers employed in these sectors, primarily women and youth, were the hardest hit. Jobs for workers earning less than $16 an hour fell by 27% in 2020, almost 5 times the decline in overall employment. Chart 1 illustrates the losses in labor income in 2020 across sectors and wage quintiles. The red bar at the top represents the lowest wage quintile. You can see clearly how these workers have been disproportionately affected by the pandemic. Together, the hospitality and retail trade sectors explain 30% of the shortfall in labor income. Less than 10% can be attributed to sectors at the top of the wage scale. That's the blue bar at the bottom. In terms of dollars, Canadians lost an average of $1,600 in labor income over 2020, and low-wage workers suffered much of these losses. Now, the red bar at the top of chart 2 shows this income loss. However, the drop in household disposable income was more than offset by the government support programs, which is the green bar in the chart. Combined, the direct fiscal support to households amounted to about $105 billion, or $3,400 per Canadian aged 15 or older. Low-wage workers collected a large portion of these transfers. In sum, as you can see from the represented by the blue bar at the bottom of the chart, the disposable income of the average Canadian rose by an additional $1,800 in 2020. While disposable income increased, the impact of the pandemic on household spending was even greater. Canadians spent on average $4,000 less in 2020 because of the pandemic. Lockdown measures and the fear of the virus kept wallets shut. To analyze this further, we can divide spending into 4 categories, as shown in chart 3. First, essentials such as food and clothing in green, non-essentials such as cars and other durable goods in blue, hard-to-distance services in both red, which represents hospitality services, and orange, which represents other services, and lastly, shelter, which is shown in gray. Hard-to-distance services, the red and the orange bars in the chart, represented more than half the decline in spending, which reflected a significant reduction in sales at restaurants, bars, and hotels. And I know you felt this impact acutely. This drop in spending was greatest in the second quarter of 2020, when lockdowns were widespread and stringent. In the second half of the year, as restrictions were relaxed, spending rebounded. The strength came primarily in non-essential goods, such as motor vehicles, recreational goods, and furniture, as people spent more time outdoors and activity in the housing market picked up. However, spending on high-contact services barely moved. To summarize these sizable shifts in income and spending, they resulted in an unprecedented increase in savings in 2020 of about $180 billion, or roughly $5,800 per Canadian. In chart 4, you can see how these savings accumulated over the course of the year as the blue and gray bars grow higher each quarter. The blue represents the spending shortfall, and the gray, the gains in disposable income. On the far right of the chart, the extra savings is broken down by income quintiles, with the highest incomes in light blue at the bottom and the lowest incomes in red at the top. Bank research suggests about 40% of the extra savings was accumulated by high-income households. Their incomes were largely unaffected by the pandemic, and they typically spend more on non-essential and hard-to-distance items. On the other hand, low-income households, the red portion at the top of the chart, accumulated less than 10% of the savings. The next step in our story is to answer the question, what have these savings been used for so far? It seems that most is sitting in bank accounts. The total value of personal deposits in banks rose by $150 billion between February and December of 2020. This exceeded the average pace at which deposits have been increasing over the past decade by $100 billion. Now, what about the rest of the savings? Evidence from survey responses and credit data indicate that some have been used to pay down debt. Given the strength of housing market activity since the summer, some have been used to purchase houses, likely by high-income earners. Similarly, some have likely been used to purchase financial assets, such as mutual funds or guaranteed investment certificates. The extraordinary size and nature of these savings and their potential impact, if spent, have sparked much debate. To get at this uncertainty, we added questions to the bank's Canadian survey of consumer expectations, which we circulate quarterly. In the November survey, only 5% of the respondents said they plan on spending most of these savings in 2021 and 2022. Another 14% plan on spending some. Based on these responses and evidence from other surveys, we assumed in our January projection that households would not dip into these savings. However, a positive surprise to spending is possible, especially if the virus is brought under control and households gain confidence about the recovery. Let's now consider the potential impact of households drawing down on their savings for consumption. We can start by thinking about how much would you be spent on goods and services and over what time horizon. As with many things related to this pandemic, this buildup of savings is unique because it stems primarily from a dramatic decline in spending on services. So it's not clear how much of the past shortfalls in spending will be made up. For example, I'm not going to get more frequent haircuts. I don't have a lot of hair, so I don't need additional haircuts. But my family might want to eat out more often. They love going out to restaurants, take an extra vacation, or buy a new television. Comparisons are often made with what happened during and after World War II. But during the war years, it was spending on durable goods, not services, that was suppressed. Such a dramatic reversal of spending is unlikely to occur now, as it did at the end of World War II, since the purchase of goods has been much less restricted. A positive surprise could still occur if households continue to buy houses and goods at a similar pace as in recent quarters, and also dip into savings to increase their spending on services. To illustrate the possible economic impact of a drawdown in savings, we considered a scenario in which certain goods and services could experience higher than normal spending because of the release of pent-up demand. In this scenario, we assume that households would spend about $25 billion, or approximately 15% of these savings. Spending is assumed to rise over this year and then be concentrated in late 2021 and early 2022 after broad immunity is achieved. In this scenario, the recovery in household consumption is brought forward. So instead of taking longer, it's brought forward into 2021 and 2022. Nominal household spending growth in 2021 would rise from 4.3%, which we projected in January, to 5% now in this scenario. In the panel on the left side in this chart, you can see the dotted line representing the upside risk to total consumption above our January baseline projection. In the panel on the left, the red line, dotted line represents the same upside risk to spending in the hospitality industry. At the peak, spending would increase at an annual pace of roughly $500 per Canadian over the last quarter of 2021. This is equal to an additional $4 billion being added to the economy in that quarter alone. We estimate that much of the extra savings would be spent on high contact services, including transportation, accommodation, and food services. Because the demand for labor would increase, we estimate that employment would rise by more than we had projected in January, by about 30,000 jobs on average each year over the next 3 years, with a peak increase of 40,000 jobs next year. Such a boost in demand and employment would greatly benefit businesses and workers such as yours, who suffered greatly during the crisis. While it is a useful exercise to assess the potential effects of households dipping into accumulated savings, this positive surprise is not guaranteed. There are also important downside risks. In January, we identified a few risks that are still relevant today. In particular, in the near term, there's the risk of another wave of infections and lockdowns as more contagious variants of the virus spread. Over the medium term, business may face increasing financial stress. We could see more firms close as the recovery progresses slowly, and our economy structures in response to changes in behavior, more persistent changes in behavior. For example, the post-pandemic world will likely see more people working from home and shopping online. This could reduce the demand for office space and retail space as well, and the related services in downtown areas. Consequently, more businesses could permanently shut their doors and let employees go. There are now 850,000 fewer jobs than a year ago, and the ranks of long-term unemployed are increasing. Prolonged spells of unemployment would erode worker skills and make it more difficult for them to find a job. While new firms may be established and workers retrained, this will take time. Monetary policy stimulus will be needed for an extended period to mitigate these risks and support both the restructuring and the recovery of our economy. So let me turn now to how all this fed into the bank's interest rate decision yesterday. As we prepared for the decision, my colleagues on the Governing Council spent a lot of time considering the signals in the latest economic data. While the unemployment rate remains elevated, economic growth in the fourth quarter was stronger than anticipated. So the Canadian economy had more momentum at the start of the year than we had anticipated. Therefore, we are no longer expecting the Canadian economy to shrink during the first quarter of this year. Housing construction and resale activity have been particularly strong. We noted that large house price increases in some markets will warrant close monitoring for speculative activity. Improving foreign demand, mostly from the United States, and higher oil and other commodity prices are positive signs that raise the prospect of stronger export growth and a rebound in investment. At the same time, Governing Council considered the recent uneven increase in job losses and the rise in long-term unemployment. There are now twice as many job losses as there were at the height of the Great Recession about a decade ago. It will take some time for the labor market to recoup these losses, given the economy will be restructuring as it recovers. One issue we discussed is the impact of this restructuring on productive capacity. We will be exploring the issue of capacity further in our next monetary policy report in April. We also considered the high levels of uncertainty around the outlook stemming from the spread of new variants, possibly leading to further outbreaks and renewed containment measures. We also discussed the outlook for inflation, which we expect will move to around the top of the band in the next few months. But this increase in inflation will not be sustained. As base year effects dissipate, the amount of slack in the economy should cause inflation to moderate. Ultimately, Governing Council decided that the economy still requires extraordinary support from our monetary policy. We reaffirmed our commitment to keep our policy rate at a record low of 0.25% until economic slack is absorbed, so that inflation can return sustainably to our 2% target. In our January forecast, we projected this would not happen until 2023. We will update our forecast in April. We also agreed to maintain our program of government bond purchases at its current pace of $4 billion a week. We continue to gain confidence in the strength and recovery. As we continue to gain confidence in the strength and recovery, the pace of net purchases of Government of Canada bonds will be adjusted as required. For the benefit of those watching the webcast of our event, I'll repeat that in French. Nous avons jugé qu'il faut continuer notre soutien monétaire exceptionnel. Nous restons engagés à garder le taux directeur à 0,25% tant que l'économie aura des capacités excédentaires. L'objectif est que l'inflation retourne à 2% de façon durable. Selon la projection de janvier, ça n'arrivera qu'au cours de 2023. Nous ferons une mise à jour en avril. Nous allons aussi continuer d'acheter des obligations du gouvernement pour 4 milliards de dollars par semaine. Ces achats seront ajustés aux besoins à mesure que notre confiance dans la force de la reprise va s'améliorer encore. I hope this gives you a sense of our decision-making process. In closing, let me stress that the Bank of Canada will remain committed to providing the appropriate degree of monetary policy stimulus to support our recovery and achieve our inflation objective. We will do our part to help Canadians get beyond COVID-19. And I can't wait for the day when I can join my family and friends at a restaurant, raise a glass, and toast the end of the pandemic. That day is coming, hopefully soon. Thank you very much for your attention, and I look forward to your questions. Thank you again.
Right, thank you so very much, Deputy Governor, for your insights and perspective on such an important topic. We're now going to start the Q&A session of today's program, and just as a reminder, you can submit your questions through the box at the right hand of the screen. And we already have a few questions coming in. So one of our members has asked, when does the Bank of Canada expect domestic and international tourism to return back to normal? And do you believe that business travel will change after the pandemic, given that people can now have virtual meetings?
Well, we all saw that travel and tourism was severely hit by the pandemic last year. And borders were closed, restrictions were imposed. So once the vaccines roll out and there's confidence that there is broad-based immunity, one would expect that travel would recover. Now, the question is, how quickly will business travel recover as quick as personal travel? My understanding from the experts is that business travel may be slower to recover, in part because I think we've all gotten used to communicating and having meetings virtually. So I think there's going to be instances where some business meetings, using teleconference will be sufficient. But I still think there is value to person-to-person meetings, especially you go to conferences in large cities. You have the opportunity to network with your colleagues. I think that is valuable. That's harder to achieve virtually. So once broad immunity has been achieved within Canada and across and in other major advanced economies, borders will open up, and I think personal travel will recover. Business travel might take a little bit longer, given that we're all used to having some meetings virtually.
Right, thank you. We had another question from another member. Given the devastating impact COVID-19 has had on our restaurant industry, what support will be required to our restaurant industry to really return it back to pre-COVID levels? And specifically, what measures, breaks should government be targeting, and for how long?
Well, that's a long question. I mean, I think what's been done so far seems to have had some positive impact. I mean, clearly there's been a number of programs targeted to the workers that in the restaurant industry, the CERB, the Canada Emergency Response Benefit, as well as the Canada Emergency Wage Subsidy, which I think has helped restaurants maintain their links to their workers. So when demand is picked up, restaurants have adapted to the restrictions in various ways. They've actually been able to rehire their employees. So I think those programs have worked. The government has adapted programs, for example, rent programs over time. There's been tax rebates and so forth. I mean, my sense is, the experience to date seems that the government's quite flexible in their response in terms of coping with the needs that various industries have shown. And clearly the restaurant industry has shouldered a heavy burden. And so I think there's going to be some flexibility to address the needs for support going forward. I can't make any commitments. I don't work for the government, and I can't specify the time frame. But I think, judging from what past experience, support was provided as needed.
Right, thank you. Younger Canadians, this is another question from one of our members. Younger Canadians, such as Generation Z, Millennials, were a key driver of food service sales growth prior to the pandemic. How were the Gen Zs and the Millennials impacted financially by the pandemic, and how will that impact their future spending?
Well, that's a very important question, Chris, because as I explained in my speech, low-wage workers were the hardest hit by the pandemic. And a lot of those workers were youth and women, as well as recent immigrants. So the youth were definitely a cohort in that group that were most greatly affected. For the most part, there were programs in place to help the youth through the crisis, but there's still a large percentage of those that are lacking jobs now through no fault of their own. There's just a lack of demand in our economy at the moment. And so it's important that as the recovery gains speed, that they enter back into the workforce, because it's important they get their first jobs. As you mentioned, the restaurant industry is often providing the first jobs for many of the youth. And that's important that they get those experiences on their resume, that they can function as strong employees. And so that's important. And that's why we're so committed to ensuring that the recovery takes hold and that we have a full recovery to achieve our 2% inflation objective. It's critical that all those workers that are currently unemployed, that want to work, get back into the workforce and get a job, because that ensures that inflation is sustainably at our 2% target.
Great, thank you, Deputy Governor. And another question from a member. Based on research discovered in regards to the amount of savings or cash being held by Canadians as a result of the pandemic, will the Banque of Canada raise the interest rate soon?
Well, our interest rate decision, our monetary policy in general, is based on achieving our inflation objective. And our objective is having 2%, having our inflation at 2% on a sustainable basis. And we've emphasized that to achieve that target, the 2% target sustainably, will require that the excess capacity in our economy be absorbed. And so looking ahead, it really is a function of how quickly our economy recovers. But, there's, as I mentioned, 850,000 jobs that we've lost since the beginning of the pandemic. So it's going to take a long time to get those people back into the workforce. So we expect that we're going to be in this situation for an extended period. In January, we said that we would be in this situation. Our forecast in January said that we would be in this situation sort of into 2023. So that's many, few quarters to go. So that's some distance into the future. So that's our commitment to Canadians, to support the recovery and help them get back to work.
Thank you, Deputy Governor. And another question that's come in from a member. What does a Biden administration in the United States mean for the Canadian economy, given the recent executive order of Buy American and the cancellation of the Keystone Pipeline? And what impact will that have on trade and the overall economy here in Canada?
Well, the Biden administration, I think there's two facets that I'd like to stress. First is that we're likely to see more predictable policy, especially trade policy, than we saw in the past. Second, there's going to be more multilateral engagement by the Biden administration, which is a good thing, because I think Canada as an open economy really requires an open global trading system, and having the U.S. behind that system really is a benefit to all countries, including Canada. As you saw in the past administration, a unilateral approach was taken, which was not beneficial for Canada, and so I see this as a strong positive going forward. Now, we've seen the U.S. become more active in the World Trade Organization, the G20, the World Health Organization. Those all require, strong U.S. leadership, and them participating more fully in those organizations is a great benefit for us and for everyone, the rest of the globe. Now, clearly, we're not going to agree on all elements of, policy between these two countries. I mean, the Buy American policy, as well as the Keystone XL, are not desirable on our part, but the fiscal stimulus that the U.S. is undertaking will have benefit for Canada. There'll be spillovers in terms of our exports to the United States, because within the United States, their economy will be growing more strongly, and that will lead to more exports. So generally speaking, I think it's a positive to have the Biden administration in place, but we're not going to agree on everything.
Thank you so much, Governor. I'm not sure if you know the question, but it's come through from one of our operators. How much debt does Canadian government estimate it will incur from beginning of the pandemic last March to the end of this year?
I don't have that number at the top of my head. I know it's in the hundreds of billions of dollars, so it's a fairly large amount. I mean, that spending, I think, was absolutely necessary. I mean, the pandemic was, people use the word unprecedented, but it was unprecedented. It's not like anything we've seen in our lifetimes. Probably won't see again, hopefully. So the government had an important role to play in terms of replacing the incomes that were lost by vulnerable workers and by firms. And so that spending was necessary and generally well targeted. So but everyone knows that this situation can't continue. And so until the pandemic is over, this type of spending will be needed. But once the pandemic is resolved, we can look at a situation where we can achieve more sustainable public finances.
Great, thank you, Deputy Governor. Another question from our members is, did the proportion of increased savings consumers are willing to spend change over time? Namely, are consumers willing to spend more of the savings now than in past generations?
I think that's true, because this experience over the course of 2020 was very unusual. I mean, a lot of people, I look at my family, we definitely didn't go out to dinner very often. We didn't take our normal vacations. So I think we're all looking for those things once the pandemic is over and once broad immunity is achieved. So I think there'll be more spending because these are sort of these are kind of windfall savings because they came from the fact that we had to suppress our spending over the course of the year. And I think there is some pent-up demand. As I said, I'm not going to get more haircuts, but my family definitely wants a few more meals out and things like that, and perhaps a new television. So there's going to be more spending, and it's going to be different than spending out of savings in the past, given what we've gone through in 2020.
Great. Thank you, Deputy Governor. One last question. What is the outlook for food prices over the next few years?
Well, food prices in our last, within the Consumer Price Index that we follow very closely, there are two types of foods we look at: foods in restaurants and foods in stores. And when we look at foods in stores, the prices over the past year has been it was roughly 0.1% in January, which is well below the normal rates of increase. Over the past 5 to 10 years, the normal rates of increase have been somewhat in the neighborhood of 1.7%. So that's lower than normal. I mean, going forward, one can expect that these food prices will increase, moving back to historical rates. I think one of the issues that we've taken note of is that if we look at agricultural commodity prices, for example, grains and meats and so forth, they've increased in recent months. And so that's likely to carry forward over the course of this year into prices of those items at the grocery store. So we'll probably see some inflation picking up, probably back to historical rates.
Great. Thank you so much. And unfortunately, we are out of time for today. And I would like to thank all the Restaurants Canada members for joining in today's event and your questions. And really a heartfelt thank you to Deputy Governor Schembri for speaking with us today. This concludes today's presentation. Please stay safe, everyone, and enjoy the rest of your day. Thank you so much.
Thank you, Chris. Thanks, everyone. Goodbye now.
you